So welcome back to another lecture here. So this is the last one we'll do in the series about different kinds of financial assets. The last one we have to concern ourselves with for this course is to talk about the market for foreign exchange, right? So what do we mean by foreign exchange? How do we determine the exchange rate? And, what kind of theoretical models do we have? And what explains fluctuations in exchange rates? That's what we'll try to do. So in the next session, we'll start to switch over and start talking about policy implications. So we'll talk about how monetary policy is administered and how interest rates are determined inside the economy. But for now, this is the last in the series around financial assets. Okay, so let's talk about foreign exchange. Uh, as usual, we'll start with the basics. We'll talk about what we mean by foreign exchange and how foreign forex markets in general operate. Then we'll talk about the theory of purchasing power parity and what that has to say about equilibrium in exchange rates. So equilibrium exchange rates in the long run. And then we'll use a supply and demand model to explain how exchange rates fluctuate in the short run, right? Right. So as a starting off point, if you take a look at the exchange rate between the dollar and a basket of other currencies around the world, so that's where we usually start uh, this kind of analysis with. So we don't really concern ourselves with one exchange rate in general, right? We might sometimes choose to focus on one pair of exchange rates between, let's say, the dollar and the euro and the dollar and some other currency. But more or less, generally speaking, we want to compare what is the exchange rate of the dollar against a basket of other competitive currencies that we want to. And what we find is that in recent years, there's been massive fluctuations in those exchange rates. Okay. And the question is, what explains these fluctuations in the dollar exchange rate? And if you pay attention to what's happening in the financial news, you'll see that this topic is coming back as a major topic of discussion, uh, given the aggressive monetary policy stance that the Federal Reserve has adopted, and amid the coronavirus pandemic, it has had serious repercussions for dollar strength around the world. So we'll talk about where how this exchange rate is determined and what explains why these fluctuations are so prominent in recent years. Okay. So before we get into all of that, obviously we start with the basics. So let's talk about what we mean by foreign exchange and how a foreign exchange market operates, right? And it's very straightforward in a fundamental sense, right? So different economies operate with different currencies. So the US operates on a dollar, India operates on a rupee, something, the European Union operates on a common currency called the euro, so on and so forth. Each country operates with its own currency for the most part. And the advantage of of issuing your own currency and operating it is because you have control over the money supply. And if you have control over the money supply, as we've talked about in previous sessions, you control what the interest rate in the economy is. And so you have a policy lever to pull on into when you want to either ramp up economic activity or essentially tamp down inflationary pressures in the economy. The primary lever that we use, that the central bank uses, is to use the interest rate channel, right? And the way you control the interest rate channel is by setting how much money supply there is in the economy, by increasing money supply if you want a lower interest rate, and by pulling back on the money supply when you want interest rates to higher and inflationary pressures to tamp down in the economy, right? So it's not a surprise that basically a country, every major economy wants to issue its own currency so that it can retain control over monetary policy. Now, the question is obviously when you invest, export, or import goods from other jurisdictions, now you need to do commerce in the domestic currency, right? So, suppose I'm a importer from China, so I buy goods from China and then import them into the US. I need to make payment to my Chinese counterparty in yen, right? Like I need to pay in the local currency. So, if I'm an exporter, so suppose I take goods from the US and sell them in India. When I sell the goods in India, essentially I receive rupees, the domestic currency, and I need a channel through which I can convert it back into dollars so I can spend that myself, right? So I have no use for rupees because rupees only accept in India. I'm a merchant who's selling the good in America, so I just need dollars. So I need some kind of exchange mechanism where I take the rupees that I received in India and turn them back into dollars. And that's basically what we're talking about with in terms of foreign exchange market. So a nominal exchange rate is basically the price of one currency in terms of another, right? So things become much simpler if you think about exchange rates as a series of prices, right? So it's not anything more complicated than that. So instead of exchanging currency for a good, we are exchanging one currency for another currency. So in a certain sense, it's still a pricing mechanism, but the good which is changing hands is other currencies, right? So the relevant good is other currencies. Okay. So appreciation, so there's two key ideas here: when a currency is appreciating and when a currency is depreciating. And appreciation is the increase in value of a currency in exchange for another currency. So what does it mean for a currency to appreciate? If I have to give fewer units of my currency to get the same amount, right? So we'll talk about exchange rates in a second, but an appreciation currency means that the value of that currency is rising, right? So fewer units of that currency can buy the same unit of whatever I was buying before. In this case, if it's a unit of foreign currency, I would need fewer units of my domestic currency in order to buy one unit of the foreign currency. And we say that the domestic currency is appreciating, right? It's going up in its value. And depreciation is the other end, where I have to give more and more units of my currency in order to possess one unit of the foreign currency. Right? So that's the decrease in value of one currency in exchange for another. Okay, so that's the basic idea. So think about so at its very core, when we talk about foreign exchange markets, this if you are comfortable with the notion that an exchange rate is basically a way of pricing currencies. So an exchange rate is basically price of one currency in terms of the other. So that if you think about it in terms of goods and services, the good that is under consideration is a foreign currency, and we're using our domestic currency to express the price of a foreign currency in terms of the domestic currency, and that's what we mean by an exchange rate. Okay, there's these two ideas about appreciation and depreciation as to what is happening to the value of the currencies themselves. Okay, so if you look at what happens, and this is a nice kicking off point in July 2016, when Britain, when the United Kingdom had its Brexit referendum, right? Uh, you saw massive. Okay, there was massive disruptions across a lot of different channels, but one channel where you saw big disruption was in the exchange rate. Right? So this is the day after the Brexit vote, so where Britain voted to exit the European Union, and you see that there is a massive crash in the exchange rate. So now, if I look at what is happening here, the exchange rate here, what it's expressing is in terms of US dollar versus British pounds, right? So this tells me that when the exchange rate comes down, right, I need to give away fewer dollars in order to get the same British pound. So what does this exchange rate? So how do I read this, right? So if the exchange rate is $1.56 for a pound, so I need to give $1.56 in order to receive one unit of the British pound. So after Brexit, instead of having to give $1.56 to have a one unit of the British pound, I only give away $1.30. So what does it mean? That the value of that currency, the value of the British pound has declined, which is to say that that currency has quote unquote depreciated. Right? And one crucial thing to recognize with interest with foreign exchange rate, with an exchange rate, is that because there's two currencies, if one currency is depreciating with respect to the other, it also means that the other currency is appreciating with respect to the original. Right? So in this case, we have a situation where the pound is depreciating against the dollar, or put another way, this is basically the dollar is appreciating against the pound. So both of them are conveying the same piece of information. It depends on what point of view you want to take, right? In this case, obviously, we were more concerned with the fact that there's a massive depreciation in the British pound, which is to say, I need to give fewer dollars away in order to get one unit of the British pound. So when a currency is appreciating or depreciating, it matters. whether you're an exporter or an importer, right? So in this particular case, would you much rather be an exporter or an importer, right? When a currency is depreciating like this, would you much rather be a person who's exporting goods from the United States uh, the UK, or would you much rather be an importer who's buying goods in UK and importing back to the US? Okay. What do you think the answer should be? If you think about it, if I have to give away fewer dollars in order to get one British pound, it is good for me to, if I'm in the position where I'm making payments in terms of pounds, but I have to use British dollars. I have British dollars and I make payments in terms of pounds. So what am I in that case? In that case, I'm an importer, right? So I'm buying something in the UK. Now, instead of having to give away $1.56 per pound to buy that gun, now I'm giving away only $1.30 to buy that gun. And that's great, right? So if I'm an importer, when I'm importing goods from the UK, a depreciating currency, a depreciating euro against a dollar or an appreciating dollar is great for me. But if I'm an exporter, now I have a different problem, right? I take a good and I sell it in the UK. I take a good from the US and sell it in the UK. Now, earlier I was getting, it's the same thing. Suppose I sold it for a pound, I could convert it back to $1.56 earlier, but now I can only convert it back when I receive a pound. I can only convert it into $1.30 now. Okay, so that's the problem, right? So when a currency is appreciating or depreciating, there's two effects, simultaneous effects, which are happening. It depends on whether you're an importer or an exporter. A depreciating currency, depreciating foreign currency is great for importers, right? Because now I'm giving away fewer dollars in order to get the same good, same value for good which is valued at £1. Now I'm giving away $1.30 instead of $1.50. Okay. And the vice versa is true if I'm an exporter. Okay. So to get a handle around all of this, there are two kinds of foreign exchange quotations in general. You have what we call a direct quotation, where exchange rates are quoted as units of domestic currency per one unit of foreign currency, right? So it's direct, so it's about the point of view. So from the point of view of when you look at a direct quotation, you're considering, okay, how many units of foreign currency do I get? If I give, how many units of domestic currency do I have to part with in order to get one unit of foreign currency? An indirect quotation is where the exchange rate is quoted in terms of units of foreign currency per unit of domestic currency. So it tells me how many units of foreign currency do I get if I give away one unit of my domestic currency. Okay. And when you look at the mapping papers in the financial press, you will see both types of quotations used. It depends on what is the point of view, what helps get the point across, right? So for instance, here we have a series of what we call foreign exchange cross rates, right? So any number here basically tells us what the exchange rate between the pair of currencies are. So if I look at this number here, 0.77, this tells me that what United Kingdom against the US dollar, right? So the third entry here tells me that I, I would need, right? I would get a 0.77 pounds for a dollar, right? So this is from the point of view of an American, of a US firm, this is an indirect quote, right? So if I take a dollar and if I take my unit of my domestic currency, which is a dollar, and I part with it, it tells me that I would get 0.77 pounds, okay? Here we have a direct quote, right? These two are going to be inverses of each other. So what does this mean? This tells me that if I give away $1.30, then I'll get a pound, right? So this is $1.30 per pound, right? So for each pound, I will need to give away $1.30. Okay. Or okay. And in this case, what does 0.77 represent? I would get, if I gave away one unit of a dollar, I would get back 0.77 pounds, or if this tells me that if I gave away $1.30, then I would get 1 pound. And these two are going to be inverses of each other, right? So this is a direct quotation in terms of the point of view of a US firm, because it's telling me how many units of foreign, how many quoted as how many units of domestic currency I need per unit of foreign currency. So this is a direct quotation in that sense, because it's telling me the dollars to pound ratio. And here, this is the indirect quotation of the same exchange rate, where it's telling me the pound to dollar ratio. Okay. All right. So there is now a question which arises, right? Now we know what the exchange rate of one unit of one currency is for the other currency. Now the question becomes, the more important thing is, that we need to recognize is that what value of real goods and services does a unit of one currency buy in another currency, right? So that's the difference between um, uh, a nominal exchange rate, which expresses the exchange rate in terms of one currency for the other, versus a real exchange rate where we are essentially trying to know the ratio between goods and services, the rate at which goods and services in one country can be exchanged for goods and services in another, right? So a very classic example of this is what the economists actually pioneered, what they call the Big Mac Index. So they were trying to find a good which was ubiquitous around the world, right? That's the first thing you need to know. How, so they looked around and they realized that there was a McDonald's franchise. Pretty much anywhere you go in the world, you can find a McDonald's. Which is to say, you can find a Big Mac in New York, you can find a Big Mac in London, you can find a Big Mac in Tokyo, and so on and so forth. So the question they came up with is that uh, let's think about the exchange rate in terms of for a Big Mac in New York, how many Big Macs? What is the number of Big Macs I get in London, or what is the number of Big Macs I get in Tokyo, and so on and so forth? Right? Do I get more or do I get less? So that tells us again a way of how we trade off between goods and services in one country for goods and services in another. This is more or less a thought experiment rather than a real deal, but this gives us a second idea in thinking about trade between two different countries. So for instance, if you think about the real exchange rate between the dollar and pound in terms of Big Macs, right? So here we have the dollar price of Big Macs in New York, right? And we have the pound price of Big Macs in London, and this tells us the dollars per pound exchange rate. Okay, so if you think about it, so suppose the dollar price of Big Macs in New York is $5. Okay, so if you want to get a Big Mac in the US, you go and pay $5 and you get a Big Mac, right? So you go to London and you want to know, suppose the price there is £4 for a Big Mac, right? So you have a dollar price for Big Mac, this is $5. There's the pound price for Big Macs, $4, and then you have the exchange rate here, right? Exchange rate between pound uh, to dollars, right? The entire notion here is to bring everything down into units of goods and services rather than in terms of currencies, right? So if the numerator is in dollars, the denominator is in pounds, you want to make this, so the price here is expressed in pounds, you're trying to convert this pound price into dollars, right? So if to convert this into this pound price into dollars, you need the dollar to pound exchange rate. So the pound and the pound cancel. So you get a dollar in the denominator, a dollar as unit in the numerator. Those units cancel, which means that you get a direct goods exchange rate, real exchange rate in terms of goods and services between these two currencies. Okay, so if this is $5 and this is $4, and suppose this is let's say 1.1, right? If suppose, let's say the dollars per pound exchange rate is 1.1. So what does it mean? Um, I get 5 here, 5.4 here. So a dollar, Big Mac in New York, if I want to trade it for a Big Mac in London, I would get something less than a full Big Mac. right? That tells me that the dollar per pound exchange rate is more than 1 to 1. Okay. So in general, this is kind of the Big Mac index, but like in general, instead of using the price of any one good, we usually use the price index in each of those currencies. So you look at the US Consumer Price Index. Here we have the British Price Index, right? So this is the dollar price. Instead of using for a Big Mac, we're looking at just a wide basket of goods and services, and the price of a wide basket of goods and services in the US is captured inside the CPI, the Consumer Price Index. And similarly, there's a British Price Index. For the typical bundle of goods and services bought in Britain, we have a British Price Index, and we have the dollars per pound exchange rate. This is what we call the nominal exchange rate. And then we can come up with a real exchange rate for all of this. Okay. So if I had to put this in an equation, the real exchange rate, which is the little figure here, E, is the nominal exchange rate times the price level in the domestic economy over the price level in the foreign economy, right? So E here is the nominal exchange rate, units of foreign currency per unit of domestic currency, okay? Remember that this has to be foreign over domestic, right? Because then the units of foreign currency here cancel with the units of foreign currency here. And then in the denominator, you have units of domestic currency that cancels with the units of domestic currency here. And that's how you get a real exchange rate. A real exchange rate is not telling us the exchange rate in terms of one currency for the other, but it's telling us how we can trade off goods and services. So if I take the typical basket of goods and services in the US and try to trade it for something in the UK, do I get the same basket back, or do I get some smaller proportion of it, or do I get a bigger basket than what it is, right? So that's how we are trying to establish what the purchasing power of that dollar is, right? So that brings us to that notion of a purchasing power, because if I look at what this equation is telling me, right, if I go back here, what this equation is telling me is that if I take a Big Mac, which I bought in the UK, in the US, take it to the UK and try to trade it for a Big Mac in the UK, do I get a full Big Mac, which tells me that the nominal exchange rate is 1 to 1? Do I get a smaller Big Mac, which tells me that the nominal exchange rate is not 1 to 1, it's actually something less than one, it's something greater than 1 to 1, depending on whether you're using the direct or the indirect exchange rate, or or something less than 1 to 1. All right, so the second thing that we need to worry about here is this notion of what we call the theory of purchasing power parity. Okay, and the theory of purchasing power parity begins with a very simple idea, which is known as the law of one price. It says that identical goods should have the same price everywhere, right? The law of one price is the idea that identical products should sell for the same price everywhere, because otherwise there's an arbitrage opportunity which arises, right? So if an apple sells for $4 and if I can buy an apple for $4 in the US, it should be the case that if I take $4 to, if I take my $4, go to Japan and give up those $4 for yen, and then I go to the market, if I'm able to buy a few more apples, instead of being able to afford instead of being able to afford a single apple with those $4, if I'm able to buy, I don't know, 3 apples for those $4, now there's an arbitrage opportunity which opens up, right? So because the price of the apple is not the same across different currencies. So the point is that if there is none of this arbitrage to exist in the real world, it means that the law of one price is a way of essentially establishing that there is no arbitrage between currencies, right? That identical products should have the same price everywhere, right? Which takes us to this notion of what we call the theory of purchasing power parity, which says that the exchange rate should adjust. So the nominal exchange rate should move such that it equalizes purchasing power of different currencies, right? So in the long run, an exchange rate should be at the level where an equivalent amount of any country's currency will buy the same amount of goods and services. Otherwise, an arbitrage opportunity opens up. Okay, so I'll show you an example of this in a second. But one key implication of this entire thing of this equation here, of this theory of purchasing power parity under if there's no arbitrage, under the conditions of no arbitrage, if we start with the real exchange rate equation, it says that E here, the real exchange rate, is the nominal exchange rate times P domestic over P foreign. So if I convert everything into percentage changes, which is to say apply logarithms on both sides. So what do I get? Ln of E is ln of capital E plus ln of P plus the ln of minus the ln of P foreign. Okay. That comes from the fact that logarithm of A over B is logarithm A minus logarithm B. And so if I express those logarithms in terms of percentage changes, what does it mean? The percentage change in little e should be equal to the percentage change in the nominal interest rate plus the percentage change in the price of the domestic price level in the domestic economy, which is basically inflation rate in the domestic economy, minus the percentage change in the price level in the foreign country, which is the inflation rate in the foreign country, right? If the theory of purchasing power parity holds, the real interest rate is going to be equal to 1, which is to say if I take one apple in the US, I can only get one apple for it in UK, right, or any other country, because identical goods should have the same price and which indicate in different countries. So if PPP holds, then E should be equal to 1. So there's not going to be any percentage change in little e in the real exchange rate, which is to say that the percentage change in the nominal exchange rate is basically compensating for changes in inflation rates between the two countries. So the theory of purchasing power parity essentially is saying that the exchange rate, the nominal exchange rate that we have in the is fluctuating. It changes based on what is happening to the inflation rate in the domestic economy and in the foreign economy. What is the relative difference between those two? Okay, because inflation rate in a fundamental sense is essentially telling us what the value of money is. If the inflation rate is high, then you need more units of that currency in order to buy the same unit of goods and services, right? Which is to say the exchange rate needs to adjust for what is happening to the purchasing power of each of these currencies, which is indicated by what is happening to the price level, or in different words, what is happening to the inflation rate in each of these different currencies. Okay. However, the point is that if you think about real world complexities, does PPP, if the question is that does the theory of purchasing power parity hold in the real world? Not really, because there are a lot of limitations on what prevents PPP from holding in the real world. For instance, not all products are internationally traded, right? It's not possible for us to leverage, even if an arbitrage opportunity opens up, it's not going to be possible for us to leverage that arbitrage opportunity if these products are not traded internationally, right? uh, Products can't be traded internationally for maybe a variety of different reasons, right? There could be tariffs, there could be quotas, there could be other trade barriers which prevent all products from being traded internationally. The second thing is that we are talking about identical products, but products can be differentiated, right? We might say that the price of an apple should be the same in two different countries because an apple is an identical product, but within an apple, there's different varieties of products, right? Different kinds and different differentiations. So once you have differentiated products, then you again straight away have a problem where the law of one price doesn't really take hold, because the law of one price is dealing with the situation where you have only identical products. You're not dealing with products which are differentiated in that sense. And there are free trade is not a as much, we have freer trade now than we had 50 years ago, but we don't have completely free trade, right? So there are tariffs and quotas that for us to consider, and that might prevent again arbitrage to happen across countries, each country's borders. So for instance, here I have like the Economist Big Mac Index. So where they have, here we have two pieces of information. the price of a Big Mac in each of the different countries here. So, in the United States, it's $4.93. In Japan, you would have to pay 370 yen. In Mexico, 49 pesos. In the United Kingdom, $2.89. And we also have the exchange rates for each of these currencies. Right? So this is the foreign currency per US dollar. So uh, I would get 118 yen for a dollar. Okay. Uh, uh, 17.44 pesos for a dollar, 0.68 of a pound for a dollar, 6.56 yuan for a dollar, and so on and so forth. Now the question is, does PPP hold it for Big Macs in the real world? Okay. So in the US, it's $4.93, and in Japan, it's 370 yen. PPP holds if the Big Mac, once I convert the yen into dollars, uh, the price of the Big Mac is the same between Japan and United States. Once I express the price of this good in the same units of currency, the price should be the same across all these different landscapes, and the exchange rate is set in such a way that the price is equalized. That's what PPP is telling us, right? So in this case, is that even true, right? So 370 yen is what I pay, right, to get a Big Mac in Japan. And so what is 370 yen in terms of dollars, right? So it's I get 118 yen for a dollar. So the dollar price of this, right? So if I had to get that, I divide 370 by the nominal exchange rate here. So yen and yen cancel, and this dollar goes into the numerator. So what do I get? So the price of the Big Mac in Japan, right? The dollar price of this Big Mac that's sold in Japan is $3.12, which is not the same as $4.93, right? And that gives us an indication that obviously PPP, the theory of purchasing power parity, does not hold for Big Macs in the US. And what explains why that is not possible? Because it's the arbitrage opportunity. What is the arbitrage opportunity, right? The arbitrage opportunity, how would you go about making profits in this? So in terms of dollars, right, I could buy a Big Mac in Japan. Now I would pay only $3.12. That's the dollar price of a Big Mac in Japan. But if I'm able to bring that Big Mac to the US, if I'm able to transport it all the way from Japan to the US, and I can sell it for $4.93, that difference between those two prices is an arbitrage profit, because I'm buying the same unit for a lower price in one currency in one place, transporting it across the world, and then selling it at a different place. The same thing that I bought for a lower price at a higher price. And now that I have an arbitrage opportunity, right? That's what it means to have arbitrage profits. But the problem you can straight away see is that it's really difficult to trade this Big Mac. This Big Mac needs to be first bought in Japan, put on a flight, transcontinental flight, and transported all the way to the UK, to the United States. The product has to stay fresh and retain same qualities and all of that by the time it hits the US. And then I need to be able to sell it in the US and realize those arbitrage profits. Obviously, you can tell that that's really not possible in that case. So the theory of purchasing power parity is more or less a theoretical result, which should hold, theoretically speaking, it should hold in the long run, but in the short run there's many limitations to what prevents it from holding. Okay, so last thing that we want to do in this uh, uh, around foreign exchange rates is to come up with a model which explains fluctuations in exchange rates in the short run. And we come up with a demand and supply model which can explain fluctuations in exchange rate in the short run, and is fairly straightforward. Okay. So uh, when we begin constructing a demand and supply model of exchange rates, we are basically determining the nominal exchange rate, right? So we are trying to determine the equilibrium nominal exchange rate. If we are able to determine the equilibrium nominal exchange rate, we are also able to determine what the equilibrium real exchange rate is, right? Because we saw what what the formulation is. Because if you hold price levels constant, and whatever percentage change there is, and the nominal exchange rate is what's reflected as a percentage change in the real exchange rate. Okay, so to construct this demand and supply model, we need to think about where the demand for dollars is coming from and where the supply of dollars is coming from, right? So the demand for US dollars demand represents the demand by foreign households and firms for US goods and financial services, right? So what does it mean? So if I live somewhere, let's say I live in Japan, but I want to buy some, a piece of land in the US, right? So if I have to buy land in the US, I need to make payment in dollars, right? So, but I have only yuan, right? I have only yen. So now I take my yen and I need to turn them into dollars. So that generates a demand for dollars from foreign households. It's not just foreign households, foreign governments everywhere around the world. Anyone who wants dollars but doesn't have dollars and needs to exchange their domestic currency for dollars generates demand for dollars. Okay, where's the supply of dollars in exchange for foreign currency is determined by the willingness of households and firms that own dollars in order to exchange them for foreign currency, because there's two conduits to trade, right? Now, there are going to be people who live in Japan who want to buy US dollar denominated assets. So they want to convert their yen into dollars, and that generates demand for dollars. Now, there's going to be people who live in the US who might want to buy assets in Japan as well, right? So they have dollars and they're willing to supply dollars into the foreign exchange market in order to get you. Yeah. Okay, so that's the two sides of supply and demand model, is that you need one party to generate the demand and the other counterparty to generate the supply. So in this case, we are basically, if you think about it, it's a two-country model. There's households in the US who want to buy yen-denominated assets, so they want to buy something in Japan. So they generate the supply of dollars in the foreign exchange market because they're willing to supply dollars in order to receive yen. The demand for dollars in this market is coming from Japanese households who hold yen. They want to exchange their yen for dollars, so they generate the demand for dollars, and that's where we get this nice little supply and demand uh, usual supply and demand framework, where on the x-axis we're measuring the quantity of dollars, and on the y-axis we're measuring the price of one good for the other, right? That's what we generally do. And in this case, we are essentially coming up with an exchange rate. It's the price of one currency for the other. Okay, and what is the exchange rate that you can come up with here? The equilibrium exchange rate tells me how many yen do I receive for $1, right? That's basically it. But based on that, you can also come up with the direct or indirect exchange rate based on what it is uh, happening. Okay, so now let's think about the demand and supply curves here. The demand for dollars in this case is downward sloping. Why is it downward sloping? What does a high exchange rate indicate, right? A high exchange rate indicates that a high exchange rate indicates that I need to give up a lot of yen to receive a dollar, right? So look at this exchange rate, it's a yen in terms of dollar. So a high exchange rate indicates that I need to give up a lot of yen for a dollar. So my demand for dollars is going to be fairly low, right? I don't want exchange, so I don't want to give up a lot of yen for a single unit of a dollar. So when the exchange rate is really high, only people who really need that dollar badly are going to demand dollars. When the exchange rate is low, which is to say I have to give up fewer yen in order to receive $1, people are going to demand more dollars. That's fairly straightforward. Okay. Similarly, the supply of dollars, right? If the exchange rate is really low, the supply of dollars is going to be fairly low as well, right? Because what does it mean for from the supply side of this market? It means that if I exchange my dollar, I'm going to receive very few yen for it, and I don't want that, right? I want like a lot more yen for it. So when the exchange rate is really high, which means that I get a lot of yen for a single unit of a dollar, the supply of dollars is also going to be significantly high, and that's the reason why we get this upward sloping supply curve here and a downward sloping demand curve here. And the usual story is an effect where the interaction between supply and demand, where the supply curve meets the demand curve, that basically determines what the equilibrium quantity of dollars traded is, but it also tells us what the equilibrium exchange rate is. Okay. All right. So what happens when these demand curves shift and supply curves shift? That's basically what the last thing that we want to do, and what causes these shifts in the demand curve and supply curve for dollars, right, in a foreign exchange setting. So let's imagine what happens when the demand curve shifts to the right, right? There is the supply of dollars stays the same in the foreign exchange market, but the demand for dollars goes up significantly. Okay, so if the demand curve shifts from the demand one to demand two, right? So that's an increase for dollars in exchange for demand for dollars in exchange for yen. So if you want like a nice story to tell yourself, is suddenly a lot of people want, a lot of Japanese people want to buy a lot of US assets, right? So they are flooding into the foreign exchange market and they want to exchange their yen for dollars. So there's an increase in demand for dollars in the dollar yen market. So we see a rightward shift in the demand curve for dollars in this market. So if the supply stays the same, if the supply is held constant, what happens to the exchange rate? The exchange rate goes up. What does it mean for the exchange rate to go up? Instead of giving up 80 yen for a dollar, now I'm forced to give up 85 yen for the dollar. And it makes sense, right? Because if there's a lot of demand for dollars, people are bidding up the price of dollars in this dollar yen market. And if you're bidding up the price of dollars in this dollar yen market, you have to be willing to give up more yen in order to receive $1. And that's basically what you're seeing here, an increase in the exchange rate, right? What happens if the supply of dollars goes up in this setting where demand is held constant? When does supply of dollars goes up? So this is where the flow is kind of reversed, where there's a lot of people in the US who are holding dollars who don't want to hold dollars anymore and want to convert them into yen, right? So they are willing to supply dollars into this market and receive yen. So if we see a rightward shift in the supply curve for these dollars, what happens to the exchange rate? There's a lot of people are willing to give up dollars now for yen. What should happen to the exchange rate? The exchange rate falls, right? So if there's a lot of people who are willing to give up dollars, now instead of 80 yen for a dollar, now it's 75 yen for a dollar, right? So the equilibrium now, exchange rate is now at a lower level because the supply of dollars in this market is relatively a lot more, right? A lot more people are willing to give up dollars. So, if that is the case, then in order to get $1 here, you need to give up fewer yen, right? Obviously, if there's a lot of people willing to give up dollars, you need to give up fewer yen in order to receive a single dollar, and that's what we see here, right? The exchange rate has fallen. So this simple supply and demand situation where you have two sides of this market, right? The demand side of this market is coming from, U.S. households who or Japanese households who want to get dollars for yen, and the demand side of this is coming from people are holding dollars who want to exchange these dollars for yen. And depending on what's happening to this demand curve and the supply curve, based on the shifts in this demand and supply curve, we are going to see movements and fluctuations in the exchange rate in these currencies as well. All right. So here's a few things which can shift the demand curves and supply curves left and right. So let's consider demand curve shifters first, and then we'll talk about some supply curve shifters as well. Okay. So what shifts demand for okay. So here's the situation. The foreign demand for US goods goes up. Okay. So there's a more increased demand for foreign goods, for US goods from foreigners. So if people want to buy US goods, they need dollars. So what happens in the foreign exchange market? The demand for dollars goes up, right? So that's represented by a rightward shift in the demand curve for dollars. If the demand for dollars is going to go up, what happens to the exchange rate? The exchange rate also rises, right? The US interest rates relative to foreign interest rates go up. Again, the same situation. So US assets are now earning a higher interest rate, which means that there is an increase in demand for dollars because people want to buy these US products which carry higher interest rates. So again, an increase, the rightward shift in the demand for dollars, which means that the exchange rate is going to be higher. Desirable characteristics of US financial securities, or somehow they become more liquid, or they're more attractive, or the returns are higher, what have you. Again, that's going to ramp up demand for dollars in these foreign exchange markets, which means that the exchange rate is going to go up. Okay. On the other side of it is what is happening to the supply curve, right? What can shift uh, the supply curve? Okay. The US demand for foreign goods goes up. So this is now reverse, right? So now people in the US want to buy a lot more foreign goods. So they're willing to exchange their dollars for the foreign currency. What happens to the supply of dollars in the foreign exchange market? You're going to see an increase in the supply of dollars, which is to say that the supply curve shifts from S1 to S2. What happens to the exchange rate? In that case, the exchange rate comes down. Similarly, foreign interest rates go up relative to US interest rates. Then people want to be invested in the foreign assets. How do you get invested in the foreign assets? You give up your dollars and take on more of the whatever foreign currency you're looking for. Again, the supply of dollars, right? So when we're thinking about the supply and demand model, we are thinking of everything in terms of dollars, right? We're thinking about you choose one currency to do the analysis. And so the demand is here for dollars, the supply here is of dollars. Okay. So desirable characteristics of foreign financial securities, right? Foreign uh, equities and other securities become more desirable. Maybe they're more liquid, but maybe they're safer, maybe the returns are higher. Whatever is the reason, you're going to see an increase in the supply of dollars in this market. Again, the exchange rate falls as a consequence. Okay. So investors basically, so if you think about these capital flows from one country to the other, about 95% of it is uh, of this foreign exchange market is basically made up of investors basically trying to move capital across different geographic boundaries, right? So for international capital mobility, where what we understand these days is that capital tries to move to wherever it can find its highest return, and sometimes that means that it has to move across the world, across the globe, through a wide different array of foreign currencies. And that's where most of this foreign exchange market, most participants in this market are basically investors who are trying to move their capital from one country to the other, and they have to navigate this exchange rate market in order to do that. Okay. And if that is the case, then there are risks involved with this. And the key risk here is about exchange rate risk, right? Exchange rate risk is that an investor will suffer losses because there are fluctuations in just exchange rates, right? So, in order to buy Japanese bonds, for instance, you assume implicitly what is known as the exchange rate risk between Japanese and the dollar, what is going to happen between the yen and the dollar. Why does it make sense? So when you buy a Japanese bond, the coupon payment is going to come in yen, right? So they're going to make their payments in terms of their domestic currency. Now, in order for you to spend that money, you need to take that yen and convert it back into dollar. So if the exchange rate is shifting, and if it's shifting adversely, so if the exchange rate gets higher, right, if the yen to dollar exchange rate gets higher, you might have to give up more yen in order to convert it back into a dollar. So effectively, the return that you're earning on the Japanese bond is going down, right? So if the coupon is paying 5%, right? Suppose it's a 5% coupon bond, but the exchange rate has gone up by 5%. Your uh, effective yield is getting reduced by 5%. So if small fluctuations in that exchange rate might reduce the yields on each of these kinds of securities, and that's what we're calling exchange rate risk. Because when you buy the Japanese bond, you're receiving payments in terms of yen. You need to convert the yen into a dollar, and if the exchange rate is basically changing in the meantime, you're assuming you're taking on exchange rate risk. The converse could also be true, right? That you receive payments in yen and then the exchange rate falls, right? So in order, so you get you give up fewer yen to receive a dollar, which is great for you, right? Because now the yield on that financial security has gone up. But when we talk about risk in the financial sense, we're talking about both the upside risk and the downside risk. It's not just downside, but that's what we're talking. Okay. Okay. All right. So, which takes us to the last big idea here is this notion of what we call the interest rate parity condition, right? So the interest rate parity condition says that, okay, so if you have bonds in different countries, so right here, so eh, the difference between, so each of these bonds, so there's a US bond which carries its own interest rate, there's a Japanese bond which carries its own interest rate, and the difference in interest rates between these two bonds needs to reflect the expected change in the exchange rate between these two currencies as well, right? Because that is how you essentially control for exchange rate risk between these two currencies, right? Otherwise, again, you have arbitrage uh, uh, profits to be realized, right? Every time a situation arises where you can leverage the fact that one currency is mispriced, relatively mispriced, relative to a other currency, you can basically try to realize arbitrage profits. So for the interest rate parity condition is again a way of imposing that there are no arbitrage profits by essentially saying that if when you think about, you know, uh, for instance, right, like to make it concrete, a US bond pays 5%, a Japanese bond pays 6%. Now, the reason why the Japanese bond pays 6% relative to the US bond is because there's an expectation that the foreign exchange, foreign exchange rate is going to move up in the future, right? So the interest rate parity condition basically says that the interest rate on domestic bond, right, should be equal to the interest rate on the foreign bond minus the expected appreciation of the domestic currency. Okay. So if this condition is not met, then you can have arbitrage profits that can be realized, right? Where you essentially take your money from one currency and go buy assets in the other currency because now you can earn a higher interest rate on the other currency. So if the expected appreciation, so if this condition breaks down, right? So basically what this is telling us is that the expected appreciation of the domestic currency is the difference between the interest rate on foreign bond minus the interest rate on a domestic bond, right? So all of that difference that we are essentially assuming between two different bonds which have the same underlying structure is basically because of expected appreciation of the domestic currency. But if that expectation is off by even a small amount, then we can realize arbitrage profits. Okay. So differences in interest rates in different currencies, it's not always about just the exchange rates, right? What the interest rate parity condition saying is that basically that. So the difference between interest rates in different uh, on bonds in different countries is basically driven by what is the expected changes in the exchange rate, and that's it's not necessarily true, obviously, right? So there are differences in default risk and liquidity between different countries. There's transaction costs, right? So in order to leverage any possible arbitrage opportunities, the transaction costs need to be as minimal as possible, and that might not always be true. There is additional exchange rate risk as well, that needs to be accounted for. So So a more modern version of this interest rate parity condition is to say that the interest rate on the domestic bond should be equal to the interest rate on the foreign bond minus any expected appreciation of the domestic currency minus what we call this currency premium. Right, this currency premium is just a way of trying to capture all these other elements or into that picture. Right. Okay. So here's a here's where we make these things concrete around the interest rate parity condition, right? So suppose you have an investment manager and they come up with this idea that their strategy is going to be that they're going to borrow money in the US at 2% and invest it in Mexico at in a comparable investment at 4%. Now, this seems reasonable, right? You're borrowing at 2% in the US, and then you will take the money that you borrowed in the US, convert it into pesos, and invest it in Mexico for a 4% uh, at a 4% rate. Okay. So, what is the problem with this analysis? So, if the interest rate parity condition holds, that 2% gap that we are seeing between a US bond and Mexico bond means that investors are expecting that the value of the dollar will appreciate against the peso by 2%. Right? That's the only reason that the gap exists, at least according to the interest rate parity condition, is that people are expecting an appreciation in the domestic currency of 2%. In this case, it's a dollar of 2%, and that's the reason why the peso is the peso bond is paying 4% and the US denominated bond is paying 2%, right? So a US investor who borrows at 2% in the US and invests at 4% in Mexico will not gain anything if the dollar appreciates by 2%. That's the crucial thing. If the dollar appreciates by 2%, because it's all done in expectation of what uh, the future appreciation in the domestic currency is expected to be. Now, it could be the case that that doesn't happen, right? So if the what happens if instead of it appreciating by 2%, it appreciates only by 1.8%. Okay, so now you have an arbitrage opportunity here, right? Because uh, even accounting for the appreciation of it, it's effectively 3.8% that you're borrowing at, right? The 2% is what is you're borrowing at 2%. Then you take into account the fact that there is going to be appreciation of 1.8%. So now it's effectively you're still borrowing at 3.8%, but now you're running a 4% return, and there is an arbitrage opportunity. So if this expectation is off even by a small amount, you can realize arbitrage profits in that sense. Okay. All right. Um, so when we consider what is happening to the dollar exchange rate, as I said, we don't concern ourselves. Okay, so there's major currencies against which we want to consider what's happening to the US dollar. Obviously, with the largest trading partners, you want to know what's happening to the dollar euro exchange rate and the dollar yen exchange rate and so on and so forth. But usually, we come up with a more comprehensive measure, what we call a trade weighted exchange rate, right? So, trade weighted exchange rate is that it's an index that measures the general value of one currency to the other, where each of these exchange rates that we are using is weighted by the volume of trade between those two countries, right? So, uh, you know, country with which you have a higher, a more concrete trade relationship, that exchange rate between those two currencies is given a higher weight in the index related to countries with which you might have very marginal amounts of trade. Okay, so what is the trend that we see in the dollar exchange rate, right? This is a trade weighted exchange rate where 1997 is said to be 100, and then we see what is happening, right? Over time, uh, the exchange rate, there's massive appreciations when there are booms and when there are crises in other sectors, right? So appreciating exchange rate, essentially what is happening, the demand for dollars is rising, right? That's when the dollar is appreciating. So what do you have in 1997? You have the East Asian currency crisis, right? Now there is a flight to safety, the dollar is considered a safe asset, and you see a big run up in the exchange rate there, right? Again, during the dot-com boom, foreign investors want to really get in on the action. So they want to buy as many US assets as possible. So you see again an appreciation in the dollar. Again, that's what we find here. In the aftermath of the uh, dot-com bubble bursting, the US responded by introducing a lot of low, keeping interest rates really low in order to support the domestic economy. And that's what we've seen here. Okay. So as the low interest rates in the US become quite low, the demand for US assets is beginning to fall off. As demand for US dollars is beginning to fall off, the US currency is depreciating relative to basket of other currencies. Financial crisis again is the same story. Where during at the peak of the financial crisis, again there's a flight to safety. Again, you see the dollar appreciating, and then as to combat the financial crisis, as the U.S. Fed started to cut interest rates and keep them fairly low, again you see a decline there, right, in the exchange rate. And over time now, again, as the interest rates are beginning to uh, rise in the US relatively. From 2014, the US started to slowly begin to raise its interest rates while foreign governments continue to keep their interest rates really low. You see again an appreciation in the foreign exchange rate. So basically what is happening is that two key ideas explain why a country appreciates and why it depreciates. A country's exchange rate is going to appreciate when there is an increase in its demand for that currency. An increase in demand for the dollars is usually when there is any kind of crisis. There's a flight to safety from investors, which is to say that they want to park their money in US dollar denominated assets. And when you see this increase in demand for US dollar denominated assets, you're going to see an appreciation in the exchange rate. Okay. The second thing that we learned from the interest rate parity condition is that it depends on what is the interest rate on a US bond versus what is happening, what is the interest rate on an equivalent foreign bond, right? So again, if the interest rates are higher in the US relative to foreign economies, again, you're going to see an increase in demand for US dollars, which is again going to cause an increase in appreciation for that, right, for the US dollar. The dollar depreciates when it becomes less attractive to be invested in, especially when other countries have higher returns, right? In this period that we saw in the aftermath of the great uh, in the aftermath of the dot-com bubble, and again to a less significant level, what happens in the aftermath of the financial crisis is that the US responds to the crisis that we've already discussed by cutting interest rates to the bone, right, in order to spur on more liquidity in the system. And one consequence of that is that foreign investors don't want to be invested in, like, in a US bond which pays like 0.2%. They're going in search of other assets which can yield higher returns, and now you see a depreciation in the currency. Okay, so here you can read through this. This is what we've already discussed as the key features here. Okay, so now coming back to the question that we opened this discussion with, why has the exchange rate not remained stable? And the simple answer to this that we've come up with so far from our understanding of the foreign exchange market is that there have been a series of crises in the last 20 years, each of which has been met by central banks in these various countries by manipulating the interest rate. And the interest rate parity condition tells us that any kind of manipulation on the interest rate is going to have a ripple effect onto the foreign exchange rate because they're tied together from our basic understanding of what the interest rate parity condition is. So as the interest rates have fluctuated very erratically over the last couple of decades, the exchange rate has also fluctuated in line with it. And that's basically what we're uh, seeing right now. Okay. So that basically does it for our discussion again in on foreign exchange markets. So if there's any questions, again, leave them in the comments below video, send me an email, and I'm happy to help. So let me know if there's any questions. Thanks for listening. I'll see you in the next one.